How business valuation works on Shark Tank. Shark Tank is a popular reality TV show that provides entrepreneurs with the opportunity to pitch their business ideas to a panel of successful investors known as sharks. One crucial aspect of the show is business valuation. In this article, we will delve into how business valuation works on Shark Tank and explore the factors that influence the valuation process. What is business valuation? Business valuation is the process of determining the economic value of a company. It is essential for various purposes such as mergers and acquisitions, investment decisions, and financial reporting. Valuation considers factors like the company's assets, liabilities, revenue, profitability, market position, and growth potential. The role of valuation in Shark Tank. On Shark Tank, the sharks evaluate the entrepreneur's business ideas and determine the value of their companies. The valuation plays a critical role in the negotiation process as it influences the equity stake the sharks will demand in exchange for their investment. The sharks aim to invest in companies with high growth potential, solid business models, and unique selling propositions. They assess the entrepreneur's pitch, product, or service viability and the potential return on investment. Factors affecting business valuation on Shark Tank. Several factors influence the business valuation process on Shark Tank. Here are some key factors that the sharks consider. 1. Revenue and profitability. The revenue and profitability of a company are crucial indicators of its financial health. Sharks are interested in businesses with consistent revenue growth and the potential for high profit margin. Companies with a solid track record of generating revenue and making profits are generally valued higher. 2. Market potential. The market potential of a product or service is a significant consideration. Sharks look for innovative ideas that have a large addressable market and the potential to disrupt existing industries. A product with a unique value proposition and a sizable target audience is likely to receive a higher valuation. 3. Intellectual property. Intellectual property, such as patents, trademarks, and copyrights, can add significant value to a business. Sharks assess the strength and exclusivity of the intellectual property associated with a company. Having robust intellectual property protection can increase the valuation and make the business more attractive to investors. 4. Competitive advantages. A strong competitive advantage sets a company apart from its competitors. Sharks evaluate the uniqueness of the product or service offered and the barriers to entry in the market. Businesses with a sustainable competitive advantage tend to receive higher valuations, as they are better positioned for long-term success. Valuation methods used on Shark Tank. Sharks employ various valuation methods to determine the worth of a company. Here are 3 common approaches used in Shark Tank. 1. Income approach. The income approach estimates the value of a business based on its expected future cash flows and the risk associated with those cash flows. The sharks consider the projected revenue and profitability of the business and apply a discount rate to account for the time value of money and the risk involved. This approach helps them assess the potential return on their investment. 2. Market approach. The market approach determines the value of a business by comparing it to similar companies that have been recently sold or publicly traded. The sharks analyze the valuation multiples such as the price-to-earnings ratio or price-to-sales ratio of comparable businesses to estimate the worth of the company in question. This approach provides a benchmark based on market trends and investor sentiment. 3. Asset approach. The asset approach calculates the value of a business based on its tangible and intangible assets. Sharks assess the value of the company's physical assets such as equipment, inventory, and real estate. They also consider the value of intangible assets like intellectual property, brand reputation, and customer relationships. The asset approach provides a foundation for valuing the business based on its underlying asset. Negotiating the valuation of Shark Tank. Once the sharks have evaluated a business, they enter into negotiations with the entrepreneurs. The negotiation process involves discussing the valuation and the equity stake the sharks will receive in exchange for their investment. The entrepreneurs and sharks engage in a back and forth dialogue, considering factors such as the business's growth potential, market conditions, and the expertise the sharks bring to the table. Ultimately, the agreed-upon valuation determines the terms of the deal. Success stories from Shark Tank. Shark Tank has been a platform for many success stories. Several businesses that secured investments on the show have gone on to achieve remarkable growth and success. Examples include companies like Scrub Daddy, a cleaning product company that has generated over $200 million in sales since appearing on Shark Tank, and Ring, a smart doorbell company that was acquired by Amazon for over $1 billion. These success stories highlight the positive impact Shark Tank can have on a business's valuation and trajectory. Challenges faced by entrepreneurs on Shark Tank. While Shark Tank offers tremendous opportunities, entrepreneurs also face significant challenges on the show. The pressure of pitching to a panel of seasoned investors, the scrutiny of their business model and financials, and the negotiation process can be daunting. Additionally, entrepreneurs must be prepared to answer tough questions and handle rejections. The competitive nature of the show demands resilience and the ability to adapt to changing circumstances. The impact of Shark Tank on business valuation. Appearing on Shark Tank can significantly impact a business's valuation. The exposure gained from the show can attract other investors, increase brand recognition, and open doors to new opportunities. The endorsement and investment from a shark can validate the business model and boost its perceived value. However, it's important to note that the valuation of Shark Tank is a snapshot in time, and the true value of a business may evolve based on subsequent performance and market conditions. Conclusion. Shark Tank provides a platform for entrepreneurs to showcase their business ideas and secure investments from successful investors. The valuation process on Shark Tank involves assessing various factors like revenue, profitability, market potential, intellectual property, and competitive advantage. The negotiation phase determines the final valuation and equity stake. The show has witnessed many success stories, but entrepreneurs must also navigate challenges and be prepared for the impact appearing on Shark Tank can have on their business's valuation. Frequently asked question. 1. Can anyone participate in Shark Tank? Yes, entrepreneurs from all walks of life can apply to be on Shark Tank. However, the selection process is rigorous, and only a fraction of applicants make it onto the show. 2. Are the sharks the only source of funding for entrepreneurs on Shark Tank? No, entrepreneurs on Shark Tank have the opportunity to receive funding from multiple sources. While the sharks are the primary investors on the show, other viewers who are interested in the presented business ideas may reach out to the entrepreneurs with investment offers after the episode airs. 3. Do the sharks always invest in every business that appears on Shark Tank? No, the sharks evaluate each business based on its merits and their personal investment criteria. They have the option to pass on a deal if they don't see a good fit or if they believe the valuation is too high. Not all businesses that appear on the show secure investment offers. 4. Can entrepreneurs negotiate the terms of the investment deal with the sharks? Yes, the negotiation process allows entrepreneurs to discuss and negotiate the terms of the investment deal, including valuation, equity stake, and other conditions. Both parties aim to reach a mutually beneficial agreement. 5. How can appearing on Shark Tank benefit a business beyond funding? Apart from funding, appearing on Shark Tank provides exposure to a massive audience and can lead to increased sales, partnerships, and brand recognition. The show has a dedicated fan base and can serve as a springboard for further business growth. 6. What happens after the episode airs and the deal is made on Shark Tank? After the episode airs, the entrepreneurs and sharks proceed with due diligence and formalizing the terms of the investment. The deal is subject to final agreements, contracts, and potential adjustments based on further analysis and negotiation. In conclusion, Shark Tank serves as a platform where entrepreneurs can present their business ideas to a panel of seasoned investors and potentially secure funding for their ventures. The valuation process on the show considers factors such as revenue, market potential, intellectual property, and competitive advantage. While sharks play a significant role in investing, entrepreneurs also have the opportunity to receive funding from other interested parties. Appearing on Shark Tank can have a transformative impact on a business's valuation, providing exposure and opening doors to new opportunities beyond funding.